Hello and welcome to Building the Premier Accounting Firm. I'm your host, Roger Knecht, president of Universal Accounting Center, and this is a show dedicated to helping you own and operate successful accounting, bookkeeping, and tax businesses. The intent here is to give you ideas of what it is you can be doing to work on your business, and most importantly, offer those quality services so as to get paid what you're worth. It's here each week that we have guests on the show to essentially explore various components of what it is we should be doing as we service our clients and as well run our company. So in this, we're going to actually have a phenomenal conversation today, one that I've been looking forward to, because I think this is going to be a little bit different than what you might expect. This happens to be Steve Selengut. He happens to be the #1 Amazon bestselling author of Retirement Money Secrets. He is also an income independence coach with over 40 years of experience in the financial industry. As a retired private investment portfolio manager, Steve has actually managed over 300 different portfolios simultaneously before selling his business in 2023. With assets under management exceeding 110 million, he has actually done a variety of things to help his clients make and earn the money that they would like. Today, Steve coaches individuals and other professionals in creating retirement income independence for both themselves and their clients, which is why we're going to be discussing this today on the show. So, Steve, welcome.
Well, thank you. Happy to be with you.
You know, one of the things I really want to kind of start with, Steve, here is the difference between finance and accounting. One of the things that I think is very interesting for us as accounting professionals is oftentimes as we work with individuals and clients, they sometimes want to have financial discussions with us because we're dealing with their money. We're obviously handling the accounting side of things. And I'm just curious, how would you define or maybe distinguish between what finance is versus accounting?
Well, in my area, finance is, developing, protecting assets, making them grow, and specifically growing the income that they produce, and making it so that regardless of what's going on in the marketplace or with interest rates, that income and that capital grows every quarter, every year, unless you spend more than you make, like I happen to do at my age, which is okay at an advanced age so much. So that's what my idea is finance. It's the production of cash flow of money. I see the accountant function as putting that money, putting that process into spaces where the tax consequences are lower than they would be if you didn't pay attention to that, but not to diminish the income, but to protect the income from taxes.
You know, I like how you're describing this. One of the things that I think is very important to maybe illustrate here is a lot of what you just said, I think an accountant could also say to a business client. And I think that's where there's that gray area of what we're both doing as financial and accounting professionals. So the thing that I'd like to add to what I heard you say is we're doing the same thing on the accounting side as it relates to business, but I think you're definitely focusing more on the individual side of those monies that they have acquired and basically protecting those personal assets that they have managed to generate over the years. So one of the things that I want to kind of show this delineation as is we work with our clients so well, they are profitable, they actually do take dividends, they take their payroll, and now they need to actually set aside things to build a nest of eggs for retirement. And one of the things that I think so often accounting professionals see is we see our clients putting everything back into the business. They're not diversifying. And so what happens is we have this conversation with them of, well, that's great that you believe in yourself and you have confidence in what you can do with the business, but I do feel that there's this need to diversify. And in my experience, I've worked very well with financial professionals. In fact, I would dare say my most effective referral partner in helping me grow an accounting business was, in fact, the financial professional. They were the ones that were having conversation with business owners who realized they didn't have the accounting and CFO and advisory support that they needed to run their business. And so for the financial professional, it was wise for them to actually have them work with me, because as we were able to work on the business and hence generate more profit, it enabled that client to get more money out of the business and give to the financial planner. So it was kind of like this well-greased will. It was a good symbiotic relationship. Have you experienced the same thing?
Oh, absolutely. In fact, I guess you could say the thing that initiated my business in the first place was that eureka moment where I was investing in high quality New York Stock Exchange blue chip companies, so to speak, all dividend payers, and started to put a lot of it into income focused stuff. And I got to the point where my portfolio and my trading practices were actually generating more income than I was making in my job. And I'm in commuting to New York City, which is an expensive proposition in itself. And then when you're not making a whole lot of money, I got to the point where I was making multiples from my investing of my salary.
Uh-huh.
And it gave me the freedom to say, I don't have to do this anymore. I'm going to talk to my dentist who's got a lot of money, and I'm going to talk to this guy who runs this restaurant out in Long Island, and I'm going to talk to them, and I'm going to show them my portfolio. Well, I built this thing from here to there and how much income it's generating for me every month, and ask them if they want me to do this for them, so that when they get to be to the point where they're tired of running that restaurant or looking in people's mouths, they can do something else. They can, move out and still know that their income from their investment portfolio is making them more literally than they were making in their profession.
I like
And that's
that.
what I do for people. I have not only dentists and restaurateurs in my community, but I also have accountants. And I have accountants who have successful practices, but they are now taking their own money and putting it into an income focused investment portfolio where they don't have to worry about where the stock market is going.
Yeah.
They don't have to guess. They don't have to make all that speculative type entries. They just know if they follow the rules, or the guidelines, I should say, they're not really hard and fast rules. If they follow the process, their income and their capital is going to grow every quarter, every year.
So one of the things that you kind of alluded to, and I'd like to dive into a little bit, is this idea of income independence. One of the things that I think we're all striving for as business owners is this idea that not only can we be profitable with the businesses that we're running, but we can eventually experience income independence. And how would you describe that?
I say it. Let's see. Income independence is the point in time where it doesn't matter to you whether the stock market is going up and down, or interest rates are trending upward or downward. Neither of these circumstances will have a negative impact on your income or your working capital. In fact, the downward movements will become opportunities for you to grow your income even faster. That's income independence. And you really can only do it with a particular type of security, one that itself is focused on income production, not just the pretty face of a rising market value, but the money it's putting into the pocket of the investors. That's the big distinction to get to income independence.
One of the things that I think you also alluded to here that I'd really like to talk about for a few minutes here is a mindset regarding money, a relationship with money. Some people don't have healthy relationships as to how they perceive or utilize money. What have you experienced in your career as it relates to the mindset, how people actually see, view, and use money?
The mindset, particularly in the finance, accounting, our types of experiences,
Mm-hmm.
the mindset that Wall Street wants you to have is a focus on market value. What you want to see from what an accountant wants to see is their client's net worth maybe increasing every year from what they're doing, or their salary if they're still employed, or their business income, their business profit production, producing this growth in net worth because of the value of the stuff they own. My focus is not so much on the value of the stuff, but the income that it produces. So my mindset is I'm focused on those numbers. How much working capital has grown. That's the amount I've got invested in all these things. How much base income is it producing? That's the amount of dependable streams of interest, dividends that are coming in. And finally, and this is a number that really can resonate with a person, is, and it's produced on all financial statements from the major Fidelity, Schwab, so forth, is the anticipated 12-month income from the portfolio. That's the thing you want to see rising every quarter, every year. If your wife tells you, we're going to Japan, India this year, and that's going to be combined, $70,000-$80,000, you want to say, okay, we'll take care of that with the income we're producing.
Well, one of the things that I'm not hearing you address that I'd like to talk about is there's two types of mindsets that I'm familiar with. And some people have a scarcity mindset as it relates to money. It doesn't grow on trees. It's hard to obtain. It's something that maybe I'm not meant to have. And so they don't see themselves as deserving this type of wealth, this type of independence, and so forth. Others, on the other time, have an abundance mindset. They see it as something that they can access and create, that they're not necessarily entitled to, but they are going to receive. And I was just kind of curious whether or not, as you've interacted with individuals, if you've actually been able to healthily take somebody from that scarcity mindset into a belief that they are deserving of wealth and they are deserving of that kind of independence.
It's amazing, the conversations in this investment community where people who just get started, and you'll have someone talking about the blizzard of distributions that just hit their accounts, like today and tomorrow. It's a blizzard of money coming in. This is their first experience, fully invested in all these closed-end funds that are producing all this money. And all of a sudden, there's 100 different dividends hitting their account. Wow. So yeah, they go from that, geez, I don't know if I have enough money. What is this inflation number? How am I going to cope with that? Type of thinking, to the thinking of, I'm in control. I am totally in control of this. I know the money's coming in. I know that I can add to positions and increase my yield and so forth. I know, and we haven't talked about the second stream of income yet, and that's the profit taking. I know when it goes up, I can take the profit and reinvest it and build my capital and thus generate more income just by doing a simple process. Schwab and Fidelity, you can just put a list and say, give me the order of the most profit. And I just take, 3 or 4 or 5 profits every day in every account. And I know I'm growing my income and my capital. And it takes away all the fear from the normal mindset. What if I don't have enough income? My kids can't pay for their kids' education. What can I do about that? Well, you can do everything about it.
Yeah.
And that's the type, it changes your mindset totally from fear to confidence. And we all know how important that is.
Yeah. So. Now, the other question I wanted to ask, and this is from the accounting space, is clearly we're working with clients that oftentimes do want to reinvest in their business. They feel like they have that control and they're trying to grow their companies. And it takes obviously a good time of marketing and sales to see that top line revenue be generated. But as we're working with them, it only makes sense that at some point they want to take distributions. They want to take some of the money out. They want to start living a little differently and live a lifestyle of an owner as they perhaps hope they might someday experience. And in that extraction of some of that asset, one of the things that they're trying to do is perhaps diversify. I'm curious, what kind of conversation have you had with business owners in the past to help them understand that they should be diversifying and investing outside of their business? What kind of conversation have you had with the accounting professionals to perhaps enable that so that they feel comfortable taking those distributions?
The accounting people are pretty easy. In my recent experience, I had my accountant. My accountant became a client of mine when I was still in the management business. And I helped her for her own personal home sales and moving, of taking that big chunk of money and developing this stream of income. And I think right now, and she's approaching 70 anyway, maybe she hasn't retired yet either. But she's at the point where she could say, okay, I could stop now. When I sold my business, and you can get there, you literally have to force yourself to put some of that money into the investment process, of course. But once you see it happening, it shows you, yeah, I was thinking I was going to wait till 70 to retire, but now I see I can do it at 65 if I want to, because I've got that income coming in. So it's not easy to get somebody to, say, okay, I don't have to buy another clerk. I don't have to open another store over here, or another car wash, or another whatever, or my accounting. I don't have to hire 3 more assistants to grow my business. If I take a certain amount out and invest it, I can grow my income. Everybody should be able to have the luxury of that decision. I'm sure accounting practices have people coming to them and say, "Hey, I want to buy your practice. Hey, you're 65 years old. You're still working. I can buy your practice from you."
Uh-huh.
But they're not going to give you all the money at once. That's what happens in financial services, because they don't want you going into competition with them. They don't want you moving your clients to, your nephew who's an accountant as well. They want you to have the same practice for a year or more. That's what they did to me. We're going to pay you, 3+, but you're only going to get 1.6 right now.
Yeah.
Okay. So I had to say, that's not a problem, guys. I want the 3.2, and, I'll take the 1 points, because I already had this portfolio that was generating nearly as much as I was making managing money for people. And with the 1.6 that I was getting immediately, I was then making more than I was when I was working. So I said, great deal. Yeah. That's where you have to get yourself. And that takes some time.
Yeah, one of the ways I like to describe what you just illustrated is the fact that when you actually take and start investing, and whatever it is, the point is you're getting to the point where you have, in essence, 2 companies. You've got the business that you're going to every day and working in, and you're selling the product or service that you have, and that's generating a net profit. But equally so, you've got this business over the side where your money is working for you, and your money is hopefully invested in various things that are equally producing a net profit. And what we're trying to do here is not just have one business, but ultimately 2 businesses that are working in our favor, so that as one gets sold, as you mentioned, you have the ability to lean a little bit more on the other that you had, because it's actually providing you now that lifestyle income that you're looking for. So that's one of the things that I've tried to more or less communicate over the time.
Get your free copy of the book In the Black, 9 Principles to Make Your Business Profitable. This is a how-to guide for accounting professionals to work with their clients and actually implement proven processes and systems to ensure that their clients make profit a priority. It is in this book you'll actually learn how to map the business and, in fact, make marketing, accounting, and production a priority within your client's business. You also learn the wisdom pyramid, how to actually take the information you're providing to your clients and effectively use it so that they can make more informed business decisions. This book is designed to help you communicate more effectively with your clients and, in fact, have them see you as their profit and growth expert. Get your free copy now of the ebook today, In the Black, 9 Principles to Make Your Business Profitable.
So here's the thing that I think would be wise for us to discuss at this point is, I know you speak of 4 great financial risk minimizers, things that we can do to, as we're investing, ensure that we're not going to be so susceptible to the losses. What are those 4 things?
What you just said was a perfect description of what you want to do. I tell people your portfolio is a department store. All the securities are for sale all the time. They're there on the shelves. You've got a target markup. Somebody wants to buy it. You don't say, no, price is going up tomorrow, I'm going to hold on to it. You say, here it is. And you take the money and you add something else to your store on the shelves, just like you were saying. That's how you have to think of it. And it's a business separate and apart from your accounting business or your legal business or your medical practice. Okay. So, yeah, in any of those situations, investing is a little bit separate, but also the same, if you think about it. Number one, it's like there are 4 legs on a stool. You have to use all 4 of these things to reduce the risk to make you have a successful investment portfolio experience.
Okay.
So the first of these, quality is job one, as we all know the Ford Motor Company says. It is. You've got to select your securities based on their quality, and you have to have a defined way of isolating the quality from the non-quality. When I was doing individual securities, it was, are they profitable? Do they pay a dividend? Very simple things. You could use PE ratio in those days and debt to equity ratios as well.
Okay.
But fundamental quality elements. With closed-end funds that I use, it's got to be in operation for 5 years or more. It's got to have at least 50 securities inside the fund. It's got to been paying a steady, stable distribution for all that period of time. Things like that.
Okay.
So quality is job one.
So quality securities.
Quality. And you got to understand what it's doing. If you don't understand it, don't buy it.
Yeah.
It's that type of thing. Quality securities selection. They got to be diversified. You got to diversify geographically by the provider of the security. If you're an individual securities, obvious diversification is more obvious, but in funds, every sector should be covered. Every type of equity and fixed income security. So you have the full gamut. Your goal is to, in my case, I own about 250 different closed-end funds and ETFs. And I pretty much feel like I've taken the defensive idea of risk minimization with diversification and added an element of offense to it. So whatever's going on, I'm going to benefit from it. It'll produce a profit in one of my sectors, one of my operations.
All right. So we've got quality securities, we've got diversification geographically and so forth.
Income production.
Okay.
Everything has to produce income. And I'm very strict. My tax-free municipal bonds have to pay over 4%. Right now they're paying 7%. My taxable income stuff has to pay over 6%. Right now they're paying 10%. And my equities have to pay over 5%. And right now they're paying about 9.3. So they must have a predictable income, dependable. And then the fourth one is one where everybody sort of is the one people don't want to touch as much.
Okay.
And that's profit taking. Because the worst thing in the world you want to happen when you're an investor and you're building up that second stream of income, that parallel business, is to have it disappear in March of 2020 or in September or so of 2008 or at the end of the year in 2020 when we've had the big crashes of our times. When you see that disappear, oh my God, I got to start all over again. But not if you're an income-focused investor.
And what does that mean?
That you have, that everything you have is paying money. Because if you look back, even in the most dire of all of the various corrections we've had in my lifetime, 87, 2000, 2008, and 2020, almost nobody went out of business. Very, very few companies even reduced their distributions. In the Great Recession, yeah, you had some financial companies go out of business, which was scary. But if you did the diversification thing, it wasn't a big deal. Merrill Lynch went under, okay. But I was only 1% of any portfolio in that, so They didn't even notice.
Interesting.
You know, when
Yeah.
Enron went bust for no reason at all, apparently, just out of the blue, they found out it was a total fraud. My wife had a couple hundred shares in an IRA, and she never noticed. It didn't matter because your diversification was so good.
Yeah.
So that's the type of thing.
I like it. So with those four things in mind, as someone's working with let's say a CFP, we can find ourselves obviously coming to the table with some of these ideas of how we can minimize our risk. So I want to go back to something that is related to this, just to get your thoughts. As accounting professionals, we're oftentimes dealing with payroll. And as we're dealing with payroll, we've got pre-tax and post-tax type things, such as the 401k, a Roth IRA, and so forth, that
Yeah.
individuals are involved in. And that's a payroll type discussion that oftentimes will come up, and individuals may ask the accounting professional what our thoughts might be on it. And I'm just kind of curious what you might say as someone is considering from a payroll point of view that decision of pre or post-tax.
Okay. The younger you are, I think the better it is for you to get into the Roth type environment in either place.
Okay.
Because you can use that and invest in the type of things I do for income and create a tax-free income environment for yourself in years to come. Very important, I think. If you can afford the after-tax money to put in there, once you have to be above a certain level in salary before you can afford to do that, before you can even contribute to your 401k or something like that. But you should do it. And when you contribute to a 401k, in my mind, you only want to do up to the point of how much the employer matches. You don't want to put anything extra in. You're better off putting that into your own portfolio and starting it to become yet another income stream. On the IRA and Roth IRA situation, if you can do the Roth, it's great. If you have to do the regular IRA, there's no problem with that either. When you get older, if you're within 10 years of not only of retirement but of RMD, you should be thinking about converting to a Roth, but only if you know how to generate significant income. Because most planners will tell you it doesn't make sense because it's going to take you 20 years to build back the money that you lost in taxes. But if you can invest at 10% to 12% and then have profit taking on top of that, you can really minimize the time it takes to get back that tax burden.
Interesting. Okay, good.
That tax take. So it depends on where you are, how much money you have, blah, blah, blah.
Okay. So the next question I want to ask is kind of some advice. A lot of times people are wondering how much to invest, and you've already answered the question as it relates to the company matching in a 401k setting. So generally speaking, and I'm just going to throw some numbers out here and just see what you would like to add. Let's assume someone was advised that they should be setting aside 10% for retirement, and they're investing 10% of their income in towards that, and the employer is matching, let's say, 6% of their investment. So clearly the first 6% could go into the 401k because it's being matched. You've got 4% that's remaining that you should be, as you suggested, doing kind of aside where you're now building up your own portfolio. Is there a magic number? Is 10% something that you typically advise your clients to be setting aside regardless of age? I mean, are there thresholds when you're younger to invest more and when you're older invest less? I mean, what are your thoughts?
I'm not a financial planner at all. So I don't really try to direct them in that. I mean,
Okay.
I can say, hey, man, you're 55 years old and you got nothing put aside for
Yeah.
You better get started. But to say what you should do when you're young and getting started, it was to my kids. I said, the more you can early, the better you'd be. I started investing when I was 25. I mean, I lucked into it. Of course, I was fortunate, I chose my parents well and all that. So I was fortunate that I was able to invest with that money. It wasn't from salary. It was from the other, the inherited, not even inherited type, but it was like a bonus,
Yeah.
But if you can do that, if you're making an adequate income and there's extra, oh yeah, jump right on it. You'd be surprised how it soothes your feelings not to ever worry about meeting a commitment or making a car payment or anything like that. I mean, geez, what the the anguish that so many people go through just thinking about that kind of stuff. When that goes away, I mean, I'm sure it adds years to people's lives when they don't have to worry about stuff like that.
Yeah.
So the sooner you can start investing and not just guessing and hoping that you're going to hit a big winner in the stock market, but investing to generate a secure stream of income, dependable income that you can actually, I'm going to put aside part of my investment income, not my salary, so that I can pay for that vacation to the Bahamas in January. You know what I mean?
Yep, I
that
do.
type of income.
Yep.
That's what people need to do. And between our two professions, I think we're perfectly equipped to lead people there by getting them interested in income-focused investing. Income-focused investing doesn't mean your market value doesn't go up. It just means that that's not the primary objective. The primary objective is to generate income. And when conditions all come together properly, like low interest rates and a popular stock market at the same time, you're going to get new all-time market value highs just like everybody else. But you're also going to be generating income, and the other guys who are just there thinking about how rich they aren't getting. You're always going to be getting more income than they are.
Yeah, that is important to know. So I do want to go back to your department store analogy. I quite liked it, and I think we passed over it too quickly because I think it's a great illustration of what we're discussing here. Because so often people, they hear about stocks and commodities, and even for that matter, real estate you could perhaps throw in there. I think that's a little bit more of a physical item, so it's not as practical. But the point is your department store analogy helps somebody understands that what they're doing is they're purchasing something and putting it on the shelf. And the question is whether or not they want to sell it to that person that comes by next for a markup, a margin, or whether or not they want to kind of hold on to it and they trust that it's going to appreciate over time. Let's elaborate a little bit more on that department store analogy, because I think sometimes people struggle to understand what's really going on as it relates to investing. What more could you add to that department store analogy?
Well, I think you could think about all the companies you know and love. They don't, the thing they fear most is an accumulation of the value of their inventory. More inventory doesn't pay their salaries, their employees' salaries. More inventory, higher value of inventories, their worst nightmare. They want turnover. They want profits. People sell you NVIDIA stock because of all the potential profits it will make, not because of its building inventory, stuff like that. That's the big distinction. The analogy makes you not fall in love with the big seven, the Magnificent Seven stocks. It says, I'm going to keep buying and selling that Magnificent Seven stock. And every time I get a chunk of profits, I'm going to put it away into something else. I'm going to diversify my portfolio and generate more income. You use CEFs, equity CEFs, which are paying over 9% on average, and I've got about 100 of them that I use. They own all of the Magnificent Seven. Those managers trade those big companies that they pay an average of less than 1% in distributions and dividends to their shareholders. Less than 1%. No respect at all for the people who laid out the money to make them successful. But the managers of closed-end funds have to pay 95% of their profits to their shareholders. So I'm owning NVIDIA. I'm owning all of those hotshot companies, but through a managed device that's paying me on average over 9%.
Well, that's an important distinction, because then you're not that day trader.
I've been known to do that, though. I mean, I'm also a profit taker, and that's, there are multiple streams of income. I have so many different streams of income. You can't imagine. From jobs, from my book is a stream of income, from my community is a stream of income, from my coaching is a stream of income. from my portfolios, Social Security. That's where you want to be. You want to have things coming in different ways. And you can do that best by generating a portfolio and recognizing that price changes are a function of the volatility of the marketplace. Prices are always going to go up and down. And you can use that to your advantage. When prices are high in the equity sector, you still buy them, but you buy less of them than you would normally. If they were way down or, in a correction, you'd buy a little bit more. Exactly the opposite of the panic syndrome that most people get into. You buy more when it goes down. You don't buy more when it goes up. You sell when it goes up, not when it goes down. And the Wall Street, what comes out from Wall Street, oh my God, it's a bond crunch. You got to sell your bonds. You don't have to sell your bonds. When they're having trouble with bonds, that's when you buy them. It's as long as you have the quality and diversification and income, you have the luxury of being able to use corrections as opportunities.
Get your free copy of the book In the Black, 9 Principles to Make Your Business Profitable. This is a how-to guide for accounting professionals to work with their clients and actually implement proven processes and systems to ensure that their clients make profit a priority. It is in this book you'll actually learn how to map the business and, in fact, make marketing, accounting, and production a priority within your client's business. You also learn the wisdom pyramid, how to actually take the information you're providing to your clients and effectively use it so that they can make more informed business decisions. This book is designed to help you communicate more effectively with your clients and, in fact, have them see you as their profit and growth expert. Get your free copy now of the ebook today, In the Black, 9 Principles to Make Your Business Profitable.
Well, let me bring this full circle back to the accounting perspective and just see what more you might be able to add as it relates to accounting professionals working with individuals like yourself, because I have found it to be very, very helpful as I'm collaborating with financial planners in the sense that they oftentimes work with business owners. They're the ones that are coming in trying to build their nest egg. They're the ones trying to determine how best to actually do things. But at the same time, their business may not be running as efficient as it could. So they come back and I get referred to them as, basically a CFO and advisor stepping in to help them run the business more profitably, to give that financial planner more of let's say, an income to work with. So my question that I want to come back to you with is, as you're working with accounting professionals, what could we best do to actually help our clients realize the power of not just running their business, but also at the same time having this nest egg that's being built on the side for themselves? It's this other stream of income as you're describing it. What could we as accounting professionals best understand to help our clients utilize this?
I think telling your clients, okay, the accountant's clients, make them aware that they should have an investment portfolio somehow, and each one will be individual. Every one of your clients is different, and they have different potential of where they can get income from or profits from to start a portfolio. But they all should know to focus that portfolio more on the income it generates than their financial professionals will encourage them to, just because of the nature of the industry. It's not focused on income. It's focused on growth of market value. And that's simply because that's how they get paid, on the amount of market value. So if every accountant listening here could have their clients read this book and start investing for income, it would give the accountants the challenge of talking to them about how to protect that the most from taxes, but also, how to smile when you see that each year they're making more money, even if this means they're paying more taxes. Paying more taxes is not bad news.
Yeah,
Paying more taxes is not bad news.
Yeah, there's a whole nother conversation we can definitely have about that. By the way, for my audio listeners, what was the book that you held up?
Oh, that was Retirement Money Secrets.
That's right. That's what Steve had written. Yes. So with that, let me just kind of bring this now kind of to an end here, because there are a few things that I'd like to really harp on. One is you shared with me one of the things that you were experiencing as it related to your strategy and the success that you were having, where you basically have $4 million that are actually within the portfolio generating a sizable return. One of the things I wanted to ask is, what is one of the guiding lights that you felt allowed you to achieve that? What's a quick answer as to what you feel really allowed that kind of experience to happen?
I guess when I got started, it was in a position where where I recognized that in 1970 it was a significant amount of money. And my main objective was not to lose it, to make it work for me,
Hmm.
not to lose it, grow it, but protect it. So that's where the quality idea and the diversification idea and the income generation ideas all came together. And then noticing the cyclical nature of markets. No matter when you start, you can look back and see that it's not been a totally upward road. During the way, there's always large, major ups and downs, significant ups and downs, and in different sectors at different times, you know? So there's endless opportunities to buy lower and sell higher. And you can be in the same stock over and over again. So I realized all that stuff. And that's what got me into this position of saying, I don't need to go speculate on anything because there's so much here with the Dow 40 or 30, with the dividend paying. There were, when I was running other people's money, there was I think 225 different stocks on the New York Stock Exchange alone that paid dividends of at least 2% that I could choose from to invest in, and then I could choose them when they were down a certain amount, and that's when I'd buy them when they were down. It used to be 20%. I'd buy them, and then I'd set a narrow target. And for that would be like even 10% was a small target in the stock market, because there are companies that do that in one day, So with dividend paying, safe, quality companies, you've got the luxury of time. And if you focus on a specific amount of profit, just wait for that to happen. You take your profit and you start over. You set this guy back into not your inventory, but the ones you'll trade, the ones you'll buy when you get a chance, and you'll keep your eye on it. And when it goes down, you'll buy it. And you'll buy it for somebody else.
Yeah, what you're talking about here is a very important strategy, and it's actually going at this with some intent and being very deliberate and focused on what you're trying to
Yeah,
accomplish. So I like that.
really.
So, Steve, one of the things that I'd like to end with is a question about your experience having run your business, sold your business, having put together this nest egg that you're also able to now live from. I'm curious, how has it changed your life with the sacrifices that you were making along the way, the different challenges that you faced as a business owner? How has it ultimately paid off for you in the sense that today you're now able to look back and realize that some of those challenges and struggles were theoretically worth it? What would you say about that?
Oh yeah, it was all worth it. I mean, my wife and I have traveled the world. I mean, we're going to India and Japan this year, within the next 10 months. And there'll be other trips on top of that. As we age and slow down, we're probably not going to be able to, climb Machu Picchu again, but we'll certainly be able to walk around a small cruise ship and go all over the world, even further, even places we haven't been yet.
Yeah.
So yeah, I mean, it's been absolutely been worth it. And I have to tell you that, that the experience that you get in your youth when you first start respecting and understanding the marketplace and getting a mindset. I mean, if I didn't have this mindset on income, I don't think I'd ever gotten to this place where I never got beaten up across the side of the head when we had a correction. I always saw it as an opportunity. And I think just that, you've experienced at least since the dot-com bubble, right?
Oh yeah.
I don't know if you were in the markets back in
I,
'87, but the dot-com bubble for sure. The dot-com bubble was strictly in that IPO, mutual fund, NASDAQ area. If you think about what I've been talking about quality and income, none of those companies were involved in that. You know, as soon as the others crashed, that's where the money went, into the good guys.
yeah.
You know, so in that dismal decade they talk about after that crash, that was only dismal in the Nasdaq. In the others, in my business, not at all.
You know, I think what you said there about mindset is the key takeaway. It's the fact that
Yeah,
you had a good mindset as it related to money and investing, and you saw it as a means to actually have the retirement that you're now experiencing. So well said on that. Here's what I'm
yeah,
going to do. I'm going to kind of wrap this up, and I'm going to come back to you for a closing thought in just a moment. One of the things that I do want to highlight is I really do appreciate Steve sharing something that I think all of you should take a look at. And it's with his website. It's theincomecoach.net. And what I'd like to do is point out in the episode description, you'll find information about that you can go look into a little bit more. But the whole idea here, and I'm really going to kind of highlight this with an offer from Universal Accounting, is a course called Money Management 101. And basically, it's a way of looking at personal finance and seeing what it is that we should understand about personal finance, whether you're an individual, a homemaker, perhaps you're in a position where you're a business owner. All people have personal income. And as they're dealing with the management of that, I think it's a great free course that you can go check out. You can also go to universalaccounting.com and in the free resource section, look at the personal finance course that is for free that you can take advantage of and see what it is you can do to learn and leverage these various principles, especially the mindset as it relates to money. Now, as a summary of our conversation, one of the things I was excited to discuss with Steve was this idea of the difference between finance and accounting. I think that's one of the things that I've experienced in my career as I've worked with individuals. They believe that because we're in the accounting space, I naturally deal with personal or finance type income, doing investments and so forth. And so it's just a natural evolution, I think, of the conversations as it relates to money. So having that distinction at the beginning that we discussed, I thought was a very good place to start. The second thing that I thought was very helpful is we were talking about mindset. So often when I'm talking to people, it's amazing to me how they view money, whether or not it's easy or difficult to acquire, whether or not it's easy or difficult to keep. And one of the things that I'd like to do is point out that with the mindset, you can actually get to the point where you can see that the money can work for itself and work for you. And in doing so, become this nest egg that continually grows. And that's one of the things that I'd like to obviously leave with. And from a mindset point of view, understand that we each need to kind of sit back and see in our youth and how we were raised, what were some of those things that we were told that are perhaps influencing the decisions that we're making today as it relates to money. The third thing I really enjoyed was the department store kind of analogy or explanation of investing. I think that's really helpful because so often when I'm working with individuals, how they choose to look at the investments that they're making, it's kind of this ethereal, I'm invested over here. But when you put it, consider it as something that you're putting on a shelf in a department store that you're going to either hold on or sell to the next person that walks down the aisle is a great way of considering that asset that you've invested in and whether or not now's the right time to let go of it and take that profit or sell it now before it becomes an old thing that's going to perish on the shelf. Well, I got to get rid of it and sell it for a loss. Either way, there's just that department store analogy that I thought was helpful. Now, one of the things that I also wanted to end on is the fact that as a business, clearly our clients are investing in themselves, what they feel they have control over, and they're clearly in a position where they're now saying, I'm going to invest in what I know I'm familiar with. But as accounting professionals, it is good to actually have them take disbursements, take those dividends, take an income. And as they're doing this, find another place that they can use to supplement the successes they're experiencing and diversify. And I think that's really important. It's clearly one of the four things that Steve shared today as to how we can mitigate our risks. So a lot of good takeaways from this. And again, as an accounting professional, I just know that in my own experience, I oftentimes kind of lend in or move into finance type discussions, which is why I was looking forward to this conversation today. So Steve, as we wrap up, what's your closing thought?
Well, if I can encourage any accounting professional to share what you just said, actually, the 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 recognition that income production, and the more streams of income you can develop, either by whatever means, a side gig if you have time for it, or an investment portfolio that keeps on growing the income it produces, it can just release you from so many stresses and strains on your activities, and what you can do, and when you have to, how much in advance you have to plan to go away somewhere, and just reduce that to say, oh yeah, you want to go there tomorrow? Fine, we'll go. That's the differential. More income, really. There's an expression right on the cover of the book, Retirement Money Secrets. It says, market value fuels the ego. Income fuels the yacht. You got to get there. You got to get to that place.
I like it. It's one thing to have a golden goose that lays the golden eggs. It's another thing to have, I think is it a gaggle? I can't remember what a collection of geese are, but
it's a gaggle.
So I think it is a gaggle. So the point is here you have now not just one, but you've got geese, a gaggle of geese that you're able to actually now leverage in your behalf that are each laying golden eggs. And that's what we want to get to, is right, that diversification, so that if one gets eaten, or if one gets hurt, or one gets injured, you still have that gaggle to lean on. So I like that idea. All right. So Steve, it's been a great conversation. I appreciate you coming on the show. For my listeners, obviously, if you haven't subscribed, I want to invite you to do so. Each and every week we have on the show guests, experts to actually help us work on our business, and most importantly, better service our clients, and in fact, build the premier accounting firm in our areas. Now, as it relates to the show, if you'd like to subscribe, please do so. Set your notifications and take advantage of these episodes each and every week. But I also want to invite you to go back and listen to past episodes. We have a fortunate library now of more than 300 episodes where you can literally go in and dive into so many topics: marketing, selling, pricing, mental health, tech stacks, how to offer quality services, onboarding clients, retaining clients, client relationships, just so many various things that you can focus on as it relates to your current situation today. So for that reason, I want to invite you to go to universalaccounting.com, and there in the navigation, you'll find the podcast section where we've compiled these highlight lists, basically playlists that you can go binge listen to, and I encourage you to take advantage of those. The other thing I want to invite you to do is join us for GrowCon. GrowCon is an annual conference for owners of bookkeeping, accounting, and tax businesses. It's a conference where we come together and collaborate, literally meeting and making new connections, building a network of individuals that are our peers, people that are doing better than us, people that we can also assist and help. And it's in those that we actually build wonderful friendships, and oftentimes from that even collaborate to better service our clients. So come and enjoy this event, GrowCon, so that you can actually build these types of connections that you need. Obviously, from there, you're also going to hear over the stage those experts that have timely information on what it is we can be doing to work on our business. And then lastly, you get to meet our staff here at Universal Accounting Center, those individuals who are committed to your success, help you be in business for yourself, but not by yourself with Universal. So if you haven't registered, definitely go to universalaccounting.com, and in the navigation, find GrowCon. There, get your ticket today, and I look forward to seeing you there. Lastly, as it relates to the training and the support that Universal Accounting Center offers, various programs that are designed to give your staff the skills that they need to offer quality services. Check out more about what it is you can be doing to invest in your staff to service your clients by becoming professional bookkeepers, professional tax preparers, profit and growth experts. Go to universalaccountingschool.com for more information, and there you'll find what it is you can be doing to invest in your staff to now become the premier accounting firm in your area. All that being said, I appreciate you being on the show today, listening in, hearing these various insights. I do want to encourage you, join us again next week, and always remember this: if it's about accounting, it is Universal. Take care and be safe out there.